Hey everyone, welcome back to Invest with Corey. Before we get to today's video, be sure to subscribe, tap the bell, and give me a thumbs up. It really helps the channel greatly, and I appreciate you for it. Also, if you have any questions, leave them in the comments below. It's my goal to answer everybody's questions as quickly as possible. My goal is to help all of you guys learn these strategies so you don't have to be stressed out. My goal is to truly help you live a better life because I'm blessed and able to do what I love to do because of options and because of trading and understanding a lot of things in the market. So I really want to help you guys be able to achieve some financial freedom, and it's my goal to bring you guys along this journey so that this way you guys can live a better life and understand the market better and reap the rewards and benefits of having financial freedom and success. Today, I want to talk about a strategy that not only is small account friendly, but also helps out large accounts. This is a very safe strategy, but has a specific use. I'm going to show you guys exactly how to set up this trade, pick the stock that you want to run it on, and then just sit back, collect the cash. Yep, just collecting cash, counting money every day, easy trades. Low risk. You guys want to enjoy the money too? Let's get started. First, I just want to point out that I'm no financial advisor, and this is not financial advice. I'm just coaching you on general strategies, but it's up to you to know your budget, risk tolerance, and which stocks you would like to invest in. I'm giving you guys the tools and the coaching on the strategies, and I'm going to show you guys how I set up this trade. I know most of you are familiar with buying calls when the market goes up, buying puts when the market goes down. As far as selling options is concerned, if we're betting on the market to go up, we sell puts. If we're betting on the market to go down, we sell calls. However, what if the market does nothing? What if I told you that you could make money even if the market did nothing? Even if the market just goes sideways and does absolutely nothing. It doesn't go down, it doesn't go up, it just goes sideways. This is the perfect opportunity to make lots of money. Yep, we're back to just counting money again. I mean, we're doing this a lot. We're constantly just counting money. When the market goes down, money. When the market goes up, money. And when the market does nothing, you guessed it, more money. How are we doing this? I'm gonna open up TradingView and show you guys exactly how to set up this iron condor because it is my favorite strategy. And to grow a small portfolio, this is one of the best strategies you can use. So first and foremost, when we're setting up the iron condor, we have to do this on a stock that's not extremely volatile. I'm going to show you guys the iron condor for any stocks that has already had earnings. Most stocks don't increase in volatility until about 2 to 3 weeks away from earnings, sometimes 30 days, and then it just gets worse and worse. But after earnings, you've got about a window of 2 weeks to a month, sometimes a month and a half, where the stock will do nothing. And implied volatility will go from 150% all the way down to 20 or 30%, which means the stock's really not doing anything. For example, we have a firm here. Implied volatility here is changing a little bit, but as you guys can see right here after earnings, it quickly dropped off and it stayed between $40, between $33 and $40 for the past month. So it's only moved $8 in either direction total, whereas before it was doing $20 jumps, $10, $15 jumps. But as you can see, this one little area from right here to right here, there was a period from February 20th until about March 14th, 3 weeks where the stock did nothing. It was between 35 and 39, a $4 movement, very little movement. This is what we're capitalizing on. A lot of people have strategies where they've got lines all over their chart, and they've got a line like this, and they've got a line like this, and they got little boxes here, and got another crazy line. That it's all nonsense, okay? It's not going to matter. Catalysts and price action don't care about lines on your chart. None of that matters. What's going on inside the candles, which is a very advanced strategy, but inside of these candles, the buying and selling is what matters. And beyond that, price action, the Bollinger Bands, and selling options. I don't use lines. I just use these little gray areas, which is price action, showing me high interest areas. That's it. You'll never see me use any strategy besides the Bollinger Bands, price action, and exponential moving averages. That's it. And you know, maybe a stochastics or a CCI down here, which are more price action, overbought, oversold signals. You're not going to see drawings or lines all over my chart. That's not going to happen. So in order to set this strategy up, first we have to go to the daily time frame right here. I'm on TradingView. You can use Yahoo Finance if you wish. I'll show you what that looks like in a minute. We're going to set up Bollinger Bands, and we're going to go to settings, and we're going to set it to 20. The length of 20 means 20 trading days, which is basically a month of trading, and a 2 standard deviation. The reason we're doing a 2 standard deviation is that collects 95 or 96% of the data, meaning as long as you stay within the lines of this Bollinger Band, you have a 96% chance of success. If the volatility is a lot higher, prior to earnings, we will go with a 3 or a 4. Standard deviation of 3 is 99%, meaning if we were to go back here and make a trade between 41 and 31, we'd have a 99% chance of success. However, that's a little overkill for any dividend stocks or stocks that have low implied volatility. Pretty much anything less than 60%, a standard deviation of 3 is insane. I wouldn't recommend it. It's going to be very safe, but the premium is going to be really low, and you're not going to be making a whole lot of this. You're really going to be risking capital to make low amounts of money. Granted, it's safe, but the reward's not quite good enough. So I go with a standard deviation of 2. 96%. It's very good. So we go ahead and look at the Bollinger Bands, the top and the bottom. This is where the Bollinger Band has captured 96% of the data, and it is highly unlikely, 96% chance the price won't go above or below these Bollinger Bands. So we figured out that the top of the Bollinger Band is 39.76, and the bottom of the Bollinger Band is 33.46. So it's safe to say a $33 put and $40 call is where we want to run our Iron Condor. And make sure you run this on the daily or the weekly, as that's the most accurate. If you're trading weekly options, I recommend daily. If you're trading bi-weekly or monthly options, you can still use the daily chart, but I recommend using the weekly chart. So go back to the 1 hour chart, and even though the Bollinger Bands has set it up like this, it is very safe. I would recommend on a firm probably to be safe, maybe going up to 41 to be a little bit safer. But this right here is how we set it up. I'm going to go ahead and put my alert at $39 and put another alert at 34. This will alert me when the price reaches those points so that I can keep a closer eye to make sure that we're not going to go into the red and lose money. Okay, so now it's time to go to the brokerage of your choice. And I'm going to pull up Affirm options. We're going to trade April 5th, which is next week. So I'm going to go ahead and set this trade up for April 5th. If you're watching this in the future, it does not matter the date. The strategy is the same no matter when you're setting up your trade. It doesn't really matter when your expiration date is. I'm going a week out. If you'd like to go more than a week out, I'd recommend doing bi-weekly or monthly on the weekly chart. But if you're using the daily chart, like I said, do the weekly expiration. So I'm going to go to sell put first. Remember, the Bollinger Band said $33 is where we want to be at. So we're going to go to $33 on the put. We're going to click sell put. We're going to click the little check mark here. Then we're going to go to buy. If you have a smaller account, you can run a $50 or $100 spread. I do not recommend it, and I'll explain why. If you're selling a $33 put and you buy the $32.50 put, there's only a $4 gap. You're only going to make $7 on $43. And you might think, okay, that's great because I'll make 14 on 100. That's 14%. That's a really good return. However, you'll see here that the break-even price is $32.93 because you're only making 7, so you can only lose 7 in order to break even. Well, watch what happens if we go to a $100 spread. Now the break-even price is 5 cents lower because we're making $12 now instead of 7. And the reason is we're collecting $29 by selling the $33 put, but we're buying the $32 call to hedge the position, which is $20. So you can see there's only a $9 difference between the two. The further we go down, the cheaper the hedged position or the purchased put is, meaning we make more money and our break even is lower. I do not like $50 spreads. Even $100 spreads are not good. I prefer $300 to $500 spreads on stocks like Affirm. And when I go to Meta and Netflix, I highly recommend running $1,000 to $2,000 spreads. However, not everybody's got $1,000 to spend in their portfolio in one trade, and not everybody has a large portfolio. So for this specific trade, I'm going to show you how to set it up with a $500 spread and a $300 spread. With a small portfolio of just $300, I'm going to show you how you can make some serious money repeatedly week in and week out. So we've sold the $33 put. Now we're going to purchase the $30 put down here. You can see we're making $22 on 300. That's almost a 10% return in 1 week. That's just the bottom end, the $33 put. Now we're going to click on call and sell, and we're going to go sell the call. Now we remember the Bollinger Band showed us $40. So we're going to go up here to $40. We can see it's 82% chance of profit and a 23 delta. Now, like I said earlier, the Bollinger Band is very accurate, 96% accurate, so to speak. So the chances of a firm going above $40 by next week is less than 4%. But I am about being safe. So I will run the $41 call, which is 86% chance of profit and only a 17 delta. When I run iron condors, if the volatility is below 50% or 60%, I don't mind running deltas of 15 to 17, but I like to keep it well below 20. If the implied volatility is above 60%, say 90 or 100 or more, I like to run deltas that are about 12% or lower, maybe even 10%. Right here, we have a delta of 17. That's fine. Implied volatility, 70%. Bollinger Band lines up. Everything lines up. $41 is safe. I will run the $41 and then I will click on buy call and I will come up here to $44 and buy this one. We don't need the collateral on the put and the call side because the price can only hit one side or the other. Meaning we don't need to put up $300 collateral for the put and $300 collateral for the call because the price can only go in one spot or the other. It's either going to hit the 41 or it's going to hit the 33. It can't be in both spots at the same time. And my brokerage knows this. So we only need to put up one collateral amount to run both sides of the trade, which is what makes an iron condor so much better. Remember, it was $22 for the $33 put. Well, now it is $47. We've more than doubled our money with the same collateral. And as long as the price stays between 33, let's go ahead and click continue. And we can see right here, the bid is between 40 and 54. Make sure the bid ask spread isn't insane. So we're going to take a quick look. These bid ask spreads are only about 4 cents apart. That's not too bad, but you're only going to get filled somewhere in the middle, meaning between 40 and 54. 47 is where we're going to get filled. I'll click it to 48. So we click review order and you can see we're going to go ahead and fill this order, 300 collateral to make $46. This is small account friendly. You could buy a call option or a put option for $300. And if you're wrong, you're going to lose that $300. That's not very friendly for a small account at all, is it? Because you could lose half your capital, maybe all of it, maybe a third of it, but you're going to lose a chunk of it. And with only having $300 or $500 in your account, you really can't afford to lose $100 or even $200. It's just not logical to trade like that. This is a 96% success rate on the Bollinger Band. The chances of a firm breaking on the high or low of this, the chances are actually quite low that a firm would do this right after earnings. When we look at this, you guys can see how much of a price movement in 5 days a firm would have to make. Now, it's not impossible, but you can see all the support down here. Our put is below the support and our call is above all these peaks. It hasn't broken above in over a month and a half. And it hasn't broken below in almost 2 months. So the chances of a firm in the next 5 days going above 40 or below 33 is very unlikely. Let me show you the difference between a $300 and a $500 spread. This was my $300 spread. You guys can see 41 and 44. We're going to go ahead and do a 46. We're going to go over to the puts and we're going to come down here and we're going to do 28. There we go. This is now a $500 spread. And instead of collecting $47, we're going to collect $56. And I like this a lot better because the break-even price is better. Not only does a firm have to hit $33 to start breaking into our profit, it now has to go down to $32.44. It has to drop an additional 56 cents just for us to break even. That is why $500 spreads are so much better than 300. In this situation, we're getting an extra 10 to 12 cents. And that is a big difference because if a firm ended up going to say 32.50, instead of losing $6, we still make $6 because we made 12 more dollars selling this option and we collect this money up front. You absolutely do not want to get pinned between the strikes. And that's something a lot of traders on YouTube don't explain. And what I mean by pinned between the strike prices is I've sold a $33 put and bought a $28 put. In scenario one, the price stays above 33. The contracts expire worthless. I keep the premium. It goes for the calls and the puts. You got to stay in between both. If the price goes below $33 and keeps going down and for whatever reason you don't close the trade out and the price drops below $28, which is your purchased put, then they both expire and you lose all your money, all $444, and And that's it. The $33 put that you sold would get assigned, and the $28 put that you purchased would be exercising and what would back you up in this situation, so you wouldn't have to do anything. Now, what I mean by being pinned in between the strikes is the price of a firm drops below 33, but it does not drop below 28. It just sits around 31. This is a bad area to be in with a small account, and your brokerage won't allow it to happen, because what happens is when you're below $33, you get assigned, but you're above 28, so you can't exercise your $28 put, meaning you have to front the cash for a firm, which is $3,300 for 100 shares. And if you only have $500 in your account or $1,000, you can't afford to do that, and you'll go into the negative. And your brokerage is not going to allow this. Let's talk about managing the trade. If the price starts to go near either of your strike prices and it just starts to peak in and it looks like it's not going to slow down, I'll close it out for a small loss, usually around 30%. So once I'm in this trade and I realize that I'm in the negative $150 to $170, and it doesn't look like it's going to turn around, I will close it for a small loss, and then I will reopen that trade. I will close the Iron Condor and I will reopen it. So I see this happening right here. And this is a call that I sold when the price was, say, right here. And I saw that the price was consolidating. I sold a $37 call right here. As soon as I see this green candle just piercing the veil through the $37 call, I will immediately get out once I realize this is not happening. I'll make a judgment call. I'll take a $200 loss. And in this position, I'd look at the previous candle and I would know that I'd want to go above this candle here. So I would just say, all right, I'm losing money right here. We're going to sell a $40 up here. So I'd close it out, sell 2 of these because the candle is moving closer to 40. I'd sell 3 of those, maybe 4. That makes back all the money I've lost. And I would open them up and let's see what would happen. And as you guys can see, it would start resisting. And at this point, these contracts are absolutely worthless. I went off of the previous candle. I saw the green candles breaking through, closed for a small loss, saw these candles over here, went above it to 40, sold a couple of those. And that's how you manage this situation, because you can't roll an Iron Condor like you would buying or selling individual legs. And what I mean by legs is if I just sell or buy this put right here, that's a leg. But if I'm running an Iron Condor, there's 4 legs. A purchased put, a sold put, a purchased call, and a sold call. 4 legs. A lot of things are going on. It's like a horse. It's 4 legs. A lot of movement going on, you know what I'm saying? So you can't open and close these things really quick. If I was able to help you understand Iron Condors a little bit better, be sure to subscribe. Give me a thumbs up as it really helps the channel. Tap the bell so you know when I post a new video. And comment below if you have any questions, and I'll do my best to answer them. Thank you so much for being here. Thanks so much for being here, guys. Until the next video, let's grow our wealth together.